Certain hedge funds were able to put up impressive returns in the midst of all this volatility. Leslie Picker joins us now with some defining attributes of those funds. I know where you're going with some of this, Leslie. Anyway, tell us about it. Yeah. Well, maybe. Well, I know one guy who did really well, and I don't know. I have my own feelings about how that happened. But anyway, go ahead.
Well, those that did put up some of the best returns this year tended to be equities focused with a human at the helm rather than an algorithm, and were oftentimes smaller in size, interestingly. Stock pickers certainly had a comeback year. According to HFR, funds that focus on energy, healthcare, and technology stocks are on pace to actually beat the S&P 500 in 2020. Funds like Tiger Global, Light Street, Coatue, D1, and Dragoneer have been some of the standouts. When combining all of the strategies together, smaller funds did better because on a fund-weighted basis, the average return for the industry is about 7%, but on an asset-weighted basis, it's negative 1.7%. That's thanks in part to some larger quant-oriented funds that are in the red this year. Think of names like Renaissance and Winton. Still, this could be considered a comeback year for hedge funds in general because most strategies did actually outperform in February and March when markets became spooked by the pandemic-induced shutdowns. That bolstered the industry's case that it really can help investors protect their downside. Guys.
Yes. Sometimes I wonder about the human involvement. Is it positive? I mean, even on a plane, right? Even on a jet, they fly themselves, but I like having two pilots, maybe four pilots, depending on the size of the jet. The AI is not, it still hasn't reached humans. Humans are still able to do so much better than computers, right? What changed?
Well, this year they were, interestingly, and part of that has to do with the fact that the way that these algorithms are oftentimes constructed is they take a regression of what a market has done historically, and then they apply that to the various asset classes based on, what could happen today. And that's kind of how they model these specific algorithms to trade, today's current markets. Well, in 2020, you have a once-in-a-century pandemic. It's very difficult to model out how the markets would function in a pandemic, since the base case is 1918. We didn't have the internet in 1918. The algorithms didn't know to plow their money into technology stocks because there was no historical analysis by which to really, benchmark from. So that's one of the main reasons why the computers had such a difficult time trading in this year. Whereas the human stock pickers were able to take a step back and say, okay, well, people are going to be working from home. They're going to be using cloud. They're going to be using the internet. They're going to be using Zoom. And they were able to invest kind of more based on their gut and fundamental analysis of what was currently going on the ground.
Shepard Smith here. Thanks for watching CNBC on YouTube.